So many traders see breakouts in the market above old highs or below old lows, and they see these as continuations. They get involved in continuation trades and just get stopped out immediately. The problem is that price liquidates external ranges of liquidity above old highs and below old lows, and then basically reverses. So you're just getting trapped. What I want to show you is how to take proper continuation trades and when it makes sense to actually get involved in trend continuations. I'm going to start with this quick 2.5 hour example on AUDNZD and then show you some more examples on silver with a quick bit of theory. So let's get started. So first and foremost, what we want to look at is what time frame are we executing on and what is our higher time frame context. So I'm swing trading right now, so I'm looking at the 12-hour time frame, and so I want to play monthly continuations or 2 weekly continuations. I need that higher time frame signal to show me when to get involved. So I'm just going to overlay first and foremost the monthly candle. And we can see right here that I can't even see the bottom of this candle right now, but there's a huge amount of bullish momentum in the market in the formation of this monthly candles range. So in theory, once we get this bullish close, we are expecting price to raid some liquidity in this area here and then continue higher to continue the trend set by this monthly candle. So with that said, that's our context. So if we now look at an intermediate time frame, what we see is that price initially sweeps above this 2-week candle's high. So we get price raiding this liquidity, closing inside this candle's range. So what price is doing is it's showing that we might want to reverse. We might want to start targeting lows at the base of this 2-week candle. But we don't really have that context from the monthly candle. So what ends up happening is that price does retrace. We get what looks like a structure shift, but actually what we're now doing is just raiding the external range liquidity below this 2-week candle. So price trades back, and eventually we get a close below, we get price breaking below the low, but a close inside this candle's range. So first and foremost, we raided this external range liquidity, price then came back, raided this external range liquidity, then we get a true market structure shift. So we have price coming down, retracing into these areas, trying to go lower, retracing, trying to go lower, and then we get a true market structure shift. So at this point here, we have everything we need to take our continuation trade because we have seen, first and foremost, a bullish monthly candle. We've seen a raid of external range liquidity on an intermediate time frame. So I'm just going to take this away. And we now have price action and a bullish price leg to go higher. So we can now start to map our internal range liquidity. So here we have the formation of a 12-hour order block. So you see this is the last sell before the buy candle right here. We also have the creation of a bullish fair value gap. So I'll mark that in green just to show you. So there's an imbalance between the first bullish candle and this bearish candle, an area of internal range liquidity that we can trade from. We also have perfect context because what price tends to do is it will accumulate, manipulate below this low, close inside the range, and then target the opposing external range liquidity right here. So that's target 1. But remember, we still have context right here from the monthly that price wants to run much further. So we can put these two things into our thinking when we place this trade, which is a long from the fair value gap covering the liquidation of this external candle's range. Now, where do we put our take profit? We have this specific take profit, which would be a 2-hour trade, or we can just start to track this under the lows as we see expansion in the market. So yes, we can get a 2.5-hour trade roughly, or we can just carry this up to something like a 3 or 4-hour. And the whole premise of this is we're taking a continuation off of the monthly candle. So what is a continuation pattern? Continuation patterns are price action formations that signal trend continuations and they happen at key higher time frame levels. Most traders either chase breakouts or enter trades that reverse, or mistake corrections for reversals and take counter trend trades. So that's the whole thing that we're trying to avoid. And it matters because we want to avoid the situation where some patterns work, some don't, and we just don't have the context we need to get better as a trader. So I want to just look at a second example on silver right here. And before I do, I just want to explain two pieces of theory. So what we're looking for with continuations is, first and foremost, we usually have candle patterns like this, whereby we see 3 candles, or it can be more than 3 candles, but usually 3 candles, whereby we have an accumulation candle right here, and then what price does is retrace and raid below the first candle, the accumulation candle. So assume there's a wick here. Then what it does is shift, we get a true market structure shift, raid this internal range liquidity, and then attack the external range liquidity at the high of this candle. So we want to look at continuation trades within this context. So this would be something like that, to take the high of the accumulation candle. The second thing that we want to look for is when we have a higher time frame candle, like we did in the last example, and we're looking for that candle to close and a new candle to shift bullish and continue. What we tend to see is that first we get a liquidation, which turns into a higher time frame wick. So price on our lower time frames will maybe do this. We'll see price initially go higher, shift bearish, fail to sustain the bearish pressure, and then attack a new piece of area of external range liquidity, or just expand off of this candle's range. So they're the two things we're looking for with continuations. Now with that said, what we see here with silver is something very interesting, because if we just take the monthly candle first and foremost, you'll see that price has closed from a monthly perspective. This candle's range closes above this candle's range. So we've seen demand sustain to the point that this candle is closed above this candle's high. So the next logical thing for price to do is attack this high and maybe go even higher. So with that said, we can then look for our continuation patterns, and we can get onto our intermediate time frame. And then we have the perfect context. So we have a raid right here of the 2 weekly low, so 2 weekly candle. Then we get price digging below this low, shifting, and then we get the emergence of a new bullish price leg right here. We also get our 12-hour order block, which sits here. So we can take a 12-hour order block trade, continuation trade, towards the high. So you'd set your order at the order block, you'd bring your stop loss below the order block's low, and then you have the perfect context for price to go higher. This is a massive trade, and remember, if we take the 2 week away and we look at the monthly, we have the context to break above this high. So yes, you might want to take something off here, but again, you can maybe just hold this and scale into this trade, and then the R multiple just expands. What's interesting as well is there is an additional trade, because you see the same thing play out where the 2 week candle closes again above its previous candle's range. So when we get this shift in the market where we see internal range liquidity created in this bullish price leg, we get the formation of an additional 12-hour order block right here. And if I zoom in with an overlapping 12-hour fair value gap at this level right here, we can get involved again. We have the same context for this continuation trade, and we can then place our stop either at the swing point or at this low here, and we have the same context. We can go higher, and this trade just runs and runs and runs. So how to apply this? Always establish your higher time frame bias, wait for failed reversals at higher time frame candle range highs and lows. So as we see that initial higher time frame external range liquidity purged, wait for price to retrace and then show you a reason that it wants to continue long. Always enter in line with higher time frame context and look for continuations of higher time frame candles. Ensure continuation structure has formed and trade using high probability entry criteria. Once you get good at this, you can do it in 10 minutes a day if you're consistent with swing trading. I trade over 32 Forex pairs. I do this every single day and I just wait patiently and execute. This is continuation trading. Check out my video on reversal trading as well, and I'll see you on the next one.